Hello traders, Samurai Trader back again. In this video we're going to be talking about trading plans and trading as a business. This is perhaps a subject that's well beyond the series of videos that I've produced here for you, because we could spend another good day just creating trading plans, because within a trading plan I believe there's a lot of the elements. But let me give you a good overview, and at the end of this video I'm going to give you a list of recommended books. Of course, if we end up doing some coaching work together, or when I launch the live room, you end up being in a live room, we'll be spending a lot more time on this subject. One thing I want to say before I move on to the next couple of slides: I believe that we all need to have a compelling future. Is that I think there's a biblical saying that says, where there is no vision, the people will perish. We've got to have a vision for the future. And with that, before I go on to some compound tables and do a little bit of dream building with you, I want to say get rich slowly. In other words, I want to talk to you about becoming wealthy sensibly, yet there are some incredible things we can achieve as day traders. But I don't want to be irresponsible with some of the things I'm about to show you. Now, I love this cartoon, and it just says so much. Every day millions of innocent people are forced from their homes by a disaster called work. Day trading and swing trading, irrespective of the amount of capital you start with, gives you incredible flexibility for your future. For an example, as soon as we finish this video, I'm back down the beach going for a walk with my daughter. It's school holidays in my part of the world, and this is what day trading does for you. So it gives you great flexibility. Now, to get there, of course, we need to have a plan. We need to consider, what sort of income can I achieve? Now, to take the next few steps with you, I need you to think outside the square. I need you to start to do some dreaming, because it's amazing what things you can do when you really believe in yourself. Now, if you haven't already heard of Robin Sharma, I recommend that you go to his website and you sign up for his free emails, and you actually go onto YouTube and Google Robin Sharma. He's got some I'll say Google YouTube him. He's got some great personal development videos there. And of course there are some other great ones, such as your Tony Robbins of the world. There's many of them. Jim Rohn, who was really, I was one of his students many years ago. But Robin Sharma is fairly modern and new, but I just love his work. And here's what he says: to achieve the impossible, you need to first develop the mindset that it's probable. Please don't allow the current limits of your life define your future reality. You deserve so much better, and the world deserves your best. Robin Sharma. I am a great one about personal development. That is, I love and I believe in it. I listen to CDs, tapes, etc., and I believe it's really what has underpinned and underpins my success as a trader and as a success coach. I want to really motivate you to really start to look at that. Now, I'd like to ask you this, and something just for you to think about is, let's just say here, and I call it the $1 million challenge. How badly do you want it? Say at the top of this mountain, if you had a rich uncle, and he was, well, he was rather strange, and he said, okay, I'm going to give you $1 million, but the key to that $1 million is going to be in a tin box at the top of that mountain. How many of us, for an example, are fearful of heights, or have no idea how to mountain climb, etc.? But how many of us over a year, and by the way there's a 1-year limit, how many of us within a year could learn how to climb that mountain to get that key to unlock the tin to that $1 million? I bet you we all could. What we do, we'd go out and we'd find ourselves some great coaches. We'd go out there, we'd develop our fitness, we'd take mountaineering lessons, some rock climbing lessons. We'd study the mountain. What's the quickest and easiest way to get to the top? By the way, no helicopters, you've got to climb it. Okay, there's some work to do. we'd all find a way of getting there. And in some ways, that's what it's like with trading. We have this opportunity to really to have this incredible income, but we've got to earn the right, and I call it earning our stripes. And I talk about this when I'm coaching all the time. You've got to earn the stripes. Now, you've already invested in this program, so I'm not trying to sell you anything here. What I'm trying to do is get you to really open your mind to what is possible. Is what would it mean to you if you could earn an extra $1,000 a week? That's only 20 pips a day on a standard lot, or 2,000 a week, or 3,000 a week on a standard lot, on 3 standard lots. It would mean for most people absolute financial security for life and financial independence. You have that opportunity. Now, this is a table, and sorry for being a little blurred. Somebody sent this. It was off another website, off a gentleman. Oh gee, what's his name? Bill. Anyway, I can't remember his name, but another gentleman that's got he's got some really good trading concepts. And anyway, it was a compound table that he had on his site, and he shows here that what if you were to make only 2 net points a day on the E-mini, that is $100 a day, starting with an account balance of $5,000 and trading one contract and making $100 a day, and at the end of a week you actually draw $250 out. And what he's doing here is, over a period of time, as the account balance grows, so does the the number of contracts that you trade. Within 13 weeks your account balance is $42,000. You're trading 20 contracts and you're earning $2,000 a day and drawing out $10,000 a week. Now, by that time, mathematically, by the way, if you calculate it, you're risking, if I remember correctly when I did this, it was 6.6% of your account balance per trade. So that's fairly high, and that was on a, if I remember, gee, I did this some time ago now, I think it was on a 1.5% risk, but you're risking about as I said, 6.6%. Now, in theory, this is really doable, because what you'd actually do, you'd scale back the amount of contracts that you're actually trading on losses. So this is really achievable. You can do this. I'm not recommending it. I certainly recommend increasing the number of contracts you trade with profitability, because you're then using the market's money rather than yours. So still saying stay within your money risk management rules, very, very important, but it's just showing you what is possible. Here is another table showing you the power of compounding with a $10,000 account and risking no more on the far right, no more than 2%, and earning 20 pips a day. On a standard lot, of course, that's $200 a day. But if you're staying within the 2% risk, it means you're trading mini lots and building. That is also extremely doable, extremely possible. Now, what I'm going to include, or have included, my apologies, in your kit is a compound table which will enable you, if you're trading Forex, and you can move this and change this around and change your risk, the account size you have, on how many pips a day and where your account size can go. I've just included that in the email you would have received, just to give you an idea. And there's another one that I've included which was sent to me by a student, and how much would you invest initially, whether it be 2,000, 5,000, how much monthly interest will you get? So if you're working on an assumption of how much you'll average, once again, please be conservative but realistic. Now, when I say conservative, I'm not saying don't put in there 100% per month. Oh, you might do it just to see where it goes, but I want you to be realistic, because you know the sort of returns that are possible, $100 to $200 a day realistically per contract you trade. So you may be working, that works out to be a good 10% per week. So go and do your own figure. So I've included these just for you to have a play around with. Once again, get rich slowly. I'm not saying be greedy here, because that's how you're going to blow your account. Now, some of the other things with your trading plan is you've seen me and heard me talk about this previously, is that I have all of my trading rules in these plastic folders that are very easy to have in front of my on my desk. Very easy for me to transport. I travel a great deal, and when I'm trading outside my home or outside of my office, I can take these as I travel around. They're also compact, very easy to have on my desk. Is that my desk is now spotless. By the way, on my trading screen, on my my keyboard, there are two little statements. One of them says age is nothing but a number. I'm in my mid-50s now, but I feel in my 20s, so I've got this little thing that says age is nothing but a number. And the other one says I trade what I see, not what I feel. Let me say that again. I trade what I see, not what I feel. Now, the other concept there is where it says here the concept of ego depletion is this: that the more decisions that you make during the day, the more likely you are to make mistakes. Let me say that again. The more decisions that you make during the day, the more likely you are to make mistakes. Likewise, the more trade setups that you trade, the more screens you look at, the more time frames during the day, you become weary, you become tired, and they actually now call it ego depletion. And so it's something I want you to be very aware of, and one of the very reasons why I have all of my rules, the patterns I look for, etc., all laid out. And every 10 minutes I'll just go through one of the folders and move to another, and I'll just continually go through, and they're very real, and I use them, and they're a huge assistance. And I recommend, if you're serious about this business, it's what you need to do. The other thing as part of your trading plan is, as you know, I'm a compulsive note taker. That is, I take notes non-stop, and I have dozens of these spiral notepads. And notice how I don't use actual notepads themselves where I'm tearing off pages, because you end up with absolute chaos. I now number these books, and as I mentioned, they're in the dozens now. So I'll fill out ideas, strategies, things to test as I'm live trading, anything I may see, etc. And I find them absolutely invaluable to go back, and it also allows you to build confidence. And so it's something I highly recommend that you do. Now, in this video also, we're going to be repeating some of the things that we've spoken about on the trading psychology video, but once again, repetition is the mother of learning. So some of it I may repeat, so excuse me if I do, but it's really relevant. Now, what we now know is that most traders blow their accounts, most new traders, within 3 months. Now, I now get the monthly statistics that the CFTC and the NFA release, so I get to see the accurate American statistics on American accounts. So I don't get them for the rest of the world, but I get to see what is happening in North America, etc., as far as live accounts go. It's now put in and lodged by all the brokers, collated, so I can see broker by broker, etc. So it's great feedback. Now, this is drilling down a little further, but of course most new traders blow their account within 3 months. The average life of a novice trader is 7 trades. It is a lot of them, they give it up, they blow their accounts. I still see so-called educators still promoting a 5% risk, per trade. Now, one thing I can promise you, unfortunately traders, I can promise you this: well, even when you first start using your trading dome, you're going to push wrong buttons, you're going to make mistakes, and that is why I always recommend, and you've heard me say 100 times, if not 2 or 3 times, you want to develop reflex action, but master your trading dome. If you're going to make a mistake, do it in demo first. Remember, I'm not saying deliberately do it at all. I'm totally against that, because you are going to hardwire those bad habits. But make your mistakes on the dome, and because you will make mistakes. And if you can afford, for an example, to have greater than 0.5% risk, just still start off and build your account. Earn the right to be trading multiple accounts. So let me explain that in more detail. Let's just say here, if you have an account of $100,000 available to start trading, you don't start risking 0.5%, 1%, 2% of that account when you first start trading. Start by trading with one contract within the rules that we talk about. 1.5%, 2% maximum risk on that contract. Earn the rights, because what that does, traders, it builds your confidence and your competence. You see, there's a big difference between having confidence and having competence. There's a big difference. So irrespective of the size of your account size, start by trading the bare minimum. If, for an example, you choose to trade Forex as your market, start by trading one mini account, one mini contract, even if you can afford to trade a standalone, and build from there. Earn your stripes, and I promise you, you will thank me for it. Do it that way, and I call it earning your stripes. Now, in your trading plan, if you're a day trader, remember, we want to really look at what is our trading personality, is to also take on the persona. Like, I'm a sniper, and it's improved my trading 100-fold. I'm patient, waiting for that setup. Now, I might get 5 to 10 shots an hour, traders, but if you go and Google the attributes, the skill set of a sniper, and take those on, I actually have them typed up in one of my pages in one of my spiral binders here, and I'll read them. And what I do, I put myself in that mindset, and it's invaluable. So in handling, as part of our trading plan, we're going to have consecutive losses. Of course, we've gone from simulation to live trading. They will happen, and you've heard me talk about, or let me say, or you will have me talk about, depending on what order you're watching this video, is that you are going to have 4 or 5 losing trades in a row. And even with myself, sometimes I'll go into a period of consolidation. At the time, I don't recognize it, and I may have 2 or 3 losses in a row. And usually, if I have 2 or 3 losses, I've gone into a period of consolidation or chop, and I haven't recognized it at the time, and that happens. But of course, having a low percentage of capital tied up in every trade, you know, you've also only going to have a couple of trades and you've made it all back again if your risk reward is right. So they will happen. Preparation's key. Psychology, your human emotion. Now, when you know your probabilities, you have confidence, and that's why you keep your trading stats. So it's estimated that 95% of traders have never written a trading plan. It's absolutely critical that we do, and it's amazing how it correlates to the amount of traders, new traders, who fail to succeed in a Forex or futures market. Trading should be treated as a business. It is a business, and it's just so critical that we operate at a business. Now, if you go to a bank to borrow money today, they want to see your plan, your business plan. You need to have a business plan, a trading plan for your strategies, your entry and exit points, when to trade, the most profitable markets to trade, etc. Because remember, different markets have different personalities, and it is so true. Just like I have my favorite markets, you'll develop those that you like. So a trading plan should be reviewed on a regular basis. Now, by the way, if I'm going too fast here, I want to get through the slides here, please feel free to stop the slides, and I hope you're taking notes. I should have mentioned that earlier. So why a trading plan? It'll give you direction, allows you to do your goal setting, allows you to look at your risk management, and of course keep your performance record, which gets back to probability trading. That just gives you a huge boost. So in your trading plan, you can have things like, why are you trading? What is your compelling future? Now, why are you doing it? Well, I trade for lifestyle, I trade for my family, I trade for financial independence, and I trade because I love it. So list it down. Which markets will you trade? Now, you may not know what markets you're going to trade at this stage. For an example, if you're based in Europe, you may be going for the DAX or the FESX, as well as of course trading the London market for Forex. You may be trading the later part of the day, the New York Open. Now, as mentioned in other videos, and I should stop saying that because you may not have seen them yet, but as I do mention that futures is basically, the futures markets are basically open 23 hours a day, Forex 24 hours a day. I think there's a couple of times where it closes for a few minutes. That's about it. Now, there are things that we need to be aware of. What times, what sessions? Of course, the London session on the Forex has the highest volume. We have the New York session for futures has the highest volume, but there's still some great trading opportunities, nearly 24 hours a day. What's your risk capital you're willing to risk? As mentioned earlier, I meet a lot of traders that have larger accounts, and in every single case I want you to start with, unless you're already profitable. And by the way, let me just think of and just say this at this stage: if you're already profitable as a trader, don't stop what you're doing. Look at what can you learn from this course and the programs I have, and maybe implement them or add. But if you're already successful, and like me, you like to research and see what else is out there and looking at enhancing, don't stop what's working. Okay, keep doing that, but look at everything I've got here. What can I learn from this? How can I benefit? How can I use this? So what's your risk per trade maximum, which should be a maximum of 2%? What's your maximum losses for the day? What's your loss limit for the day in dollars? And what's your risk of ruin? That is, how much of your account are you willing to lose in total? Now, there's a whole lot of key fundamentals that you need to look at with your trading platform. You've got to learn how to use the trading platform. You've got to understand your own personality. You've got to keep your methodology simple. As mentioned, start off by trading a very small position, so you're keeping within that 2%. And even if you have well within that and you've got more money, you earn the right. You step up, you add contracts as you're earning the right. Because one of the greatest challenges is this, that it doesn't take long before we suffer psychological damage as traders. Now, I know some of you are thinking, all right, Samurai, what are you talking about now, psychological damage? Traders, it's true. It hits our self-esteem. Besides hurting our pocket, when we start making mistakes, it hits our confidence. It starts to really affect us. And dealing with the psychological damage, that's probably one of my biggest jobs that I have now in dealing with traders. Because what happens is, when you start to become psychologically damaged as a trader because of the mistakes you're making, you start to hesitate when genuine trading opportunities come up, and before you know it, they've passed. It's too late, and you get on this merry-go-round. And Murphy's law is, okay, I'll sit out this trade. That's a winning trade, so you're getting on the next trade. Guess what? That's a losing trade. So the next, okay, I'll sit out the next 2 trades in, and guess what? Both of those are winners, and you get the thing, and you spiral out of control. And so it's just so important that you keep accurate stats and you ensure that you're not psychologically damaged. because it really is a true syndrome in our industry. So our trading plans are going to be different because each of us are different. Each of us are different financially. Your hours, your availability to trade will vary. So the big thing here is, of course, is to really work out what's best for you. And this is why you need to do your apprenticeship. You need to spend some time not trading with cash, sitting back, watching, taking notes, and working out, and if you like, tailoring your individual plan. Now, one of your plans may be here that you've got 5,000 risk capital. You're only willing to risk 1% here. That makes it a lot easier, by the way, if you're trading Forex, because you can trade mini accounts. Of course, you're greatly limited if you're trading futures because of the minimum account balance that you need to have. You may choose to have it that you have 3 losses and you stop for the day. Now, I've now developed a skill set that I totally ignore the amount of losses because of my probabilities. I can have 3 losses, that's very easy, but because I get that many trades and that discipline now. However, initially in the early days, this needs to perhaps be more rigid to get more flexibility as you gain confidence. By the way, let me just say this: if ever you come across a trader that tells you how good they are, and once again, be open-minded. All right, question, they say that the sign of an intelligent person is how open they are to new ideas. So be open-minded. But one of the things I'm really interested in when I'm talking to a trader is, what is their risk parameters? That tells me a great deal about a trader. So maintaining discipline, I talk about this in the trading psychology video, but do not chase lost money. For an example, turn off your phones, shut your door, get plenty of rest, don't drink and trade at the same time. Don't drink alcohol, that is. Drink plenty of water, yes. Once again, stand regularly, keep the blood flowing, avoid trading for thrills. Yes, trading still is exciting for me, but it's also very boring at times. But you've got to be careful when you get bored that you don't lose focus and you don't take impulse trades. Now, when you do take impulse, if you do, I hope you don't, so let me reframe this for a moment. Write it down in your journal. If you take an impulse trade, all the little things that you, the good, the bad, and the ugly, I call it, it's very important that you put it in your trading journal, should say, pardon me, the good, the bad, and the ugly. So what market you're going to trade, your position size, your risk percentage. So you can, once again, put a hold on this video and go through this in detail. Take notes off this. One of the things that I do is I take a lot of screenshots, and I have Snag it on my computers, so both my laptops and my office and my home computers, and I'll take screenshots. And I have folders on all of my computers that I call charts to study. And so what I'll do is I'll take screenshots of trade entries and exits, I'll type in notes on them, and I'll review them as a reminder. And likewise, in a quiet time of trading, or just in a time of study or doing research and development, I'll sit back and I'll review the chart shots that I've had. Now, managing risk is one of the biggest things, of course, that we need to do. I still see educators, getting back to other educators, talking about having a mental stop. Well, traders, I just think that's crazy. You've got to have a stop in, and you've got to follow the rules. Look, I've been just as guilty as many other traders in the past of moving stops, believing the market's going to turn around and bounce. I mean, this is one of the problems that we have with counter trend trading, where we just believe, or many traders just can't believe that the market is not going to turn. It can't go any higher, but guess what, 80% of the time it does, etc. So there's just so many things that we need to be aware of here. And this is where there's some, as I mentioned, some excellent books like by Tharp, Trade Your Way to Financial Freedom. You've got there by John Carter, Mastering the Trade. Larry Williams, well, Larry's not a big one, by the way, on short-term trading, as much as he's written a book called, which is a great book, by the way, Long-Term Secrets to Short-Term Trading. But Larry himself will talk more about longer term trading himself. So there's some great books out there on managing risk and things that we should be doing, but we need to spend a lot of time on it. And this is a little chart that I had on another slide that I cut and pasted and put here, that when you go and lose, say, 20% of your capital, you need, as a percentage return, 25% to get back. But you go and lose 50% of your capital, you've then got to earn 100% on your money to get that capital back. So the more you lose, the harder it is to get back to break even. So having a look at this next slide. So why do the majority of people who attempt to trade lose? Now, I know some of the things that I go on and on and on. I know I get wound up, I get excited about this because I love trading, and I want you from the bottom of my heart to be incredibly successful. I want your emails, I want your phone calls, I want you to tell me how well you're doing, but you really are doing. Okay, so I'm being candid with you here. So most traders lose because they overtrade, or they buy and sell too much for their trading capital reserve. In other words, they're not staying within their risk management, they're not placing stop loss orders, or they don't limit their losses. And particularly when you first start out, in a way, like I shouldn't have told you, I don't stop after 3 losing trades in a day. Do you know why? Because some of you, when you're brand new, will still keep trading. Well, don't. Put a limit in, and say if you have 3, it might be 4 or 5 losing trades in a row. Now, by the way, if you're risking only 0.5% and you have a sound trading strategy and you know your probabilities, maybe you might make it 5 losing trades before you stop for the day. Because if you've had 5 losing trades, just maybe it's time to stop for the day, flip over to the simulator, and take in trading sim, and review the mistakes you've made. Is it something maybe you are doing? Okay, don't destroy your confidence. Don't get to a stage where you suffer from psychological damage from trading. Okay, and of course, lack of knowledge, education, and a lack of knowledge and education comes down to not doing your homework. The knowledge is not spending time earning your stripes. So remember, 30 to 60 days minimum to learn this trading, or to learn, let me say that again a little bit different, to learn how to trade. Remember, you're going to trade the rest of your life. You've got plenty of time. Let's do it the right way the first time. I've spoken about the 2% rule. It's very easy to sit down to calculate what 2% of your trading account is. This is where, getting back to Forex, as I used in an example, you have a lot more flexibility in trading mini accounts compared to, say, trading standard lots on futures. Now, a lot of brokers will tell you, yes, you can trade, the day trading margins are only, say, $1,000 with us if you trade the E-minis or the YM or whatever. But if you've got a stop loss of, let me just give you a figure of $75, well, that's 7.5% of your daily margin. So if, say, you've got $5,000 in your account, your broker says to you, which by the way, most reputable brokers will not recommend this at all, but say you've got 5,000, you can trade 5 lots. Now, you're risking 7.5%, so your risk of ruin has been dramatically increased. And of course, you erode that margin that you've got very quickly, and you can't even trade any longer. So these are considerations and things you need to really look at. Now, on risk reward, it depends what part of the world you live in. Like some people refer to 3 to 1 risk reward. Others it's the other way around. So really have a read of this slide. But what I'm saying here is, for every $3 you aim for, you don't want to risk any more, or a 1-to-1. For every dollar I risk, I want at least $1 back. Now, for those of you that watch me trade, know I as a scalper, I'm after a minimum of 1-to-1 minimum you have to go for, and I usually try to go at least one tick more than a risk reward of 1-to-1. The reason being, I want to cover my brokerage, because when you're trading a lot, scalping the market, your brokerage, your commissions really mounts up. If I do 20 scalps in a day, that's about, I think it works out for me about $180 per contract in brokerage. So sorry, that's not quite right. That's about $80, sorry, per contract. So it really adds up. $80-$90. Sorry traders, I'm not focused on what it works out to be, but it does work out to be a lot. So you want to really be aware of that. So if you're just going for 1-to-1, your brokerage really will eat into that. So the higher the better. Now when I'm counter trend trading, I must be after 2-to-1. I've got to get $2 back for every dollar I risk, because on say the T89s, as much as they're really high probability, they're not as good as the T2s or the T25s. So these are considerations with your trade setups that you need to think about. Now let's talk about stop placement fairly quickly. I talk about it in the video recordings, and you can read a lot about it in the books that I recommend. So they're really absolutely essential. Now there's really money stops, saying okay, I'm not willing to risk any more than $50 per trade. You might work on a percentage of your account stop, but the type of stop loss that I really want to work on is, for me, is what I call let me go back, so I'm jumping ahead here, technical or intelligent stop, that is below my swing low or swing highs. Now with these, I'm going to let you read these in detail. Read money stops. Please stop the video and just have a read of this one here on a percentage stop, percentage of your account. However, I believe they're quite dangerous. You need to really, when I say dangerous, that's an exaggeration. I don't think there is anywhere near as prudent, for an example, as using a technical stop. A technical stop is where you're going to have your stop 1 or 2 ticks above or below your closest swing high or swing low or support or resistance. Now this really comes down to doing the research on the market that you are trading. What is the best thing for you to do? Where should it be? Now I may be wrong, by the way, when I'm saying to you a technical stop, an intelligent stop. You may have a trading strategy that you don't need to do that. Now let me give you an example where that may be. If you are a scalper, a momentum scalper, that is, you will hear me talk about that time is not on your side. That is, if you're in a fast moving market, the market should continue. So if I'm trading a tick chart, a short term, I jump in say a T25. A T25 trade, you can have a much tighter stop because it's a short-term pullback with other traders doing some profit taking, but it's a continuation trade, generally speaking. If you're looking at your anchor chart, a higher time frame, you know that you're already in an uptrend or a downtrend. You've had a short pullback, and on your trading chart, on your trade entry chart, away you go, you're in, and you can have a very tight stop. However, as I talk about on the T25 video, I'll still have, as an example on the NQ, a minimum stop of say 8 ticks, because I will give it some room to breathe. That stop, by the way, is dependent on the time frame you are trading. So if you're trading say a 550 tick chart, 8 pips or 8 ticks is not going to be enough. So experiment, look at the time frame that you are trading before you decide what stop you're going to be using. But in other words, spend some time on working out which is the best stop for your trading strategy, methodology, market, and time frame. Now, your profit targets. Really, there are so many things that we could do here, and we can spend a lot of time, which is beyond the scope of this video series about targeting your profits, but I do want to spend a little bit of time for you. Now, this is really where you want to have a bare minimum profit target of 1 to 1, 1 to 2 recommended. Now, as a scalper, and if you look at the ES, the market truly works in waves. And on the videos, you'll hear me talk about having a maximum or being extremely cautious after you've had 3 to 4 trades, particularly after 3 trades in a trend, because the market is like a breathing, living organism. It'll breathe in and out. You have waves. Now, I'm not going to talk to you about Elliott waves, etc. And of course, there's a lot of people love Elliott waves and study Elliott waves, but you'll see in this particular case, I'm talking about pullbacks or retracements. So please be very careful. But the point I want to get across here is this, that when I have a trade entry, say after a T98 or even after a T89, which generally or quite often leads to a change, at least for the short term, in market direction, those first 1 or 2 trades in the new market direction, you can have a much higher or a higher profit target because it's the start of a new trend. Now, it might mean that you've got to take a little bit of heat, you'll have a bit of a pullback and whatever, but your first 1 or 2 trades in a new trend, you're going to have your much better profit target or much better returned on. So spend some time looking at that. And when I'm doing coaching, this is where we spend a lot of time, is you'll see that. And once again, it's beyond the scope here of this video to go and spend a lot of time on wave trading, but it's really important that you look at that. So looking at profit targets, there are a number of things you've probably seen. Some of my videos or some of my webinars where I live trade, and quite often I'll just have a set target on multiple contracts. Trading a 10 lot, I'll have a set target. And when questioned by traders, why do I do that? It's because a lot of the time I'm trading in a very fast market. So if you look at, say, the NQ133 tick, you'll see it moves fairly quickly. And for my personality, I want to get in, get out, but I know my probabilities, and I've got some very high probability trades that I take. That suits me. So if you're trading a single contract, that may work for you, but you've got to make sure your risk reward is right. You may choose to have multiple targets, take so many off, and then go to break even and ride the rest. So there's no right or wrong with some of these, unless of course, that's a global statement I just made, unless of course your risk reward's not right. But look at sometimes you can, as you become really good on your trading day, you can trail your stops. You might target the upper or lower floor pivots. As an example, you'll see this every day. Price will quite often, and a high probability of the time, will go from one floor pivot to another. Yes, you'll have some pullbacks or retracements on the way. You can take measured moves. Now, measured moves are very good on your first 1 or 2 trades in a new trend. Please Google that and have a look at what a measured move is, because it's really something we need to spend about an hour on to really show you how to do measured moves, but they work really well. You might use your 8 EMA. One of the strategies you can use for profit targets is as long as you're on for longs on the right side of the EMA, you can stay in a trade until you have a close over the EMA or on the, sorry, let me say that again, I said that wrong. As long as you're on the left hand side of the EMA, sorry traders, on the left hand side you may stay long. Once you cross over on the right side, you get a close over the 8 EMA, you exit your trade. Now another great technique, and on my videos I mentioned standard error bands. Now most charting packages now have standard error bands, and they have a standard setting of 21. And very simply, standard error bands in a fast moving market, they narrow. So the same rule almost applies to the standard error bands as to the 8 EMA. When you get a close over them, on that is to the right, if you're long, you may exit your trade. Now once again, please apply them and do some research on this area. Now one word of caution before I move on here for a moment: when you get what works, stick with it. Don't chop and change, constantly looking for the holy grail of trading strategies or stops and profit targets, etc. Find something that works, make that work. Once again, focus, and then look at other things. All right, add them once you're profitable on one thing. In other words, don't chop and change regularly. That's what I'm probably trying to say here. So but standard error bands are really interesting, but remember, they're also adding another thing to your chart, which is something you want to be cautious of: alligator stops. Now I talk about in one of my videos about the alligator moving averages as put out by Bill Williams in his book New Trading Dimensions, which is published some years ago now, and he wrote an excellent book, I think, gee, it must be a good 20 years ago now, called Trading Chaos and the Theory of Fractals, etc. And the trigger line 8, which is something that we use in the T98 setup, is one of those alligator moving averages. Now please Google that. There's a lot of information on the alligator and using his offset 3 moving averages. Now it's complicating things a little, and I believe there's easier stops, such as trailing stops and etc., and having your profit targets, but it's still very interesting. And maybe in some of your spare time, in your quiet market times, you might want to do some reading there. Of course, another profit target, which is a really logical one, particularly when you're using your anchor charts, is your swing highs and swing lows. We could talk about this for hours. You've got then profit targets, of course, using Fibonacci. You've got here in this particular case, this is an old slide from a seminar I did a long time ago, but here we've got targeting. We had a 50% retracement on our fib level, and our first profit target here is we're taking the top of our little swing high here. The other thing you can be using, of course, is using Fibonacci extensions, and there's a lot of work being done on this, and also using measured moves such as, and hopefully you can see my icon moving here, taking that point to this point, so point A to point B, and extending it from C, so putting A to B up here. A measured move, taking that point and putting it from there to there. There are just so many things you can do when it comes to trading, and all of this forms, of course, part of your trading plan. Now this video, now we've been going for nearly 50 minutes. We've been going, so I've been going on, and I'm trying to give you incredible value here in very short time. So in closing this video, there are 2 slides here on some excellent books that are out there. Now once again, I've spoken about the trading strategies. Traders, I have a massive library of hundreds of books, videos, CDs. You've probably seen or even photos of the research folders that I've got dozens of them. So if you're new to trading, or if you've purchased this program to fast track your trading career, use what is in this program, because the trading strategies work. They're all there already for you. I've already done the research for you. I've already spent with researchers and trading staff years on this for you. So I'm just bringing these up as books to broaden your knowledge. An example, Master in the Trade, Carter talks about what I call the super scalper. He talks about it in his book, and a lot of ideas that John talks about I use in my trading and I teach. So on all of these, there's some good stuff in all of these books, and here's some more. And some of these are classic books, have been around for many years. However, the market has a memory, and the patterns repeat themselves day in, day out. I've also mentioned Tony Robbins and Robin Sharma, Jim Rohn, the great Jim Rohn, who passed away I think it's 3 or 4 years ago now. All of these are all about self-development. Now, I already know some of you are rolling your eyes. I can see you, I can imagine you, but for me it's been invaluable, and for me it's developed my discipline. It's developed my trading plan and where I wanted to go. Now, just in closing, one thing I want to quickly say, which I don't think I mention on any of the videos, is the myth about the multi-million-dollar trader. And I get to experience this firsthand with floor traders. The floor traders that are working for the institutions might have, say, $20 million in purchasing power. It is not their money, traders. They have a boss that they answer to, being their manager. They have strict money management rules applied. They have maximum losses, etc., etc. I still see a lot of those traders leave and go out and trade their own capital and fail. Why? Because they don't have their coach, they don't have being their manager. They're trading their own money, which quite often is their savings. So they're trading what I call scared money. I know of very few professional traders that are trading multi-million-dollar accounts where it's their own money. It is so much easier to trade a fund when it's not your hard-earned cash. So you'll find very few traders out there, and I tend to find most pro traders I know are trading with only a few $100,000 of their own cash, and that's sort of about it, because of the comfort factor when it's your own money. I just felt this really prompted to mention it, just looking at some of the names here, because it's a lot easier to trade someone else's capital. So getting back to realistic trading plans, spend some time on it. You need to have a plan, because if you don't, if you're not planning, you're going to fail. That's the bottom line. So that's the end, because I'm starting to ramble a bit, traders, but please go back, re-listen to this. Hopefully you've taken a lot of notes, and you'll see me on the next recording. Thank you.